All right, let's get right to it. This is your urgent briefing on the March 25th SVELTE Intelligence Report. It's designed to give you the critical signals you need for your strategic planning, effective immediately.
So let's just start with the single most important number that's hit the wire in the last 48 hours. This one right here, negative $41.72 trillion.
And let's be perfectly clear, this isn't some forecast, it's not some think tank's model. This is the official number, published by the U.S. Treasury straight from their own books. This single data point underpins a massive shift in the strategic landscape, and we're going to be coming back to it.
The core thesis of this SVELTE report is pretty simple and pretty stark. We've got three structural crises that we've all been tracking separately. Well, they're not separate anymore. They've started to converge, and now they're feeding off each other.
So to really get our heads around this, we've broken down the report's 9 most critical outlier events. The data points with the biggest potential for disruption. And we've grouped them into 3 clear, thematic crises. This is the framework that helps us see how it all connects.
Okay, crisis number 1. Let's call it the geopolitical tinderbox. This is the immediate fire that everyone sees. It's the external shock that's escalating in the Middle East and Eastern Europe right now.
And just look at the massive gap between what the world was expecting and where we actually are. The conflict in Iran has just refused to follow the script of a quick resolution. Markets were pricing in a cool down, but instead, oil is stuck stubbornly over $110 a barrel. That is just injecting maximum uncertainty into the entire global system. And make no mistake, this isn't just about oil. It's a full-blown, multi-front geopolitical pressure cooker. Peace talks in Ukraine? Stalled. Russia's digging in. A critical LNG supply from Qatar has been suspended for 4 weeks now, and nobody can get a straight diplomatic signal from either Washington or Tehran. It is a complete mess of signals. Now let's move to the second crisis, because this is where things get really structural. We are witnessing a fundamental rewiring of economic and military policy among the world's major powers. This is long-term, foundational change.
Just think about these 3 things all happening at once. You've got Europe launching its biggest coordinated rearmament since the Cold War. You have China, for the first time in decades, publicly admitting it's in for a major structural slowdown. And then you have the U.S. firing off a new wave of protectionist tariffs against, well, pretty much everyone. These aren't tweaks, these are seismic shifts. And that brings us to the third crisis. And honestly, this might be the most structural one of all. It's happening right here, inside the U.S. economy itself. The report calls it the Great Bifurcation.
I mean, this slide just says it all, doesn't it? On one hand, you have a public sector that is, by its own math, technically insolvent. On the other, you have a private tech sector so flush with cash that it's funding a $750 billion AI build-out, and it's doing it almost entirely on its own. It's like 2 completely different economies living in the same country. Okay, we really need to double-click on this U.S. fiscal situation for a minute. Why? Because the implications for how we value everything are immediate and profound. This signal changes the single most important assumption in modern finance.
And yeah, the report pulls no punches here. It's not a debate. They're just stating a fact based on the Treasury's own numbers. They're saying, look, by any standard accounting definition, the U.S. government is insolvent.
And if you need a number to put that into perspective, here it is. $1.22 trillion. That's not spending on programs. That was just the cost of paying the interest on the national debt last year. It is the first time in history that number has ever crossed $1 trillion. And don't think for a second this is some far-off 50-year problem. The Highway Trust Fund is projected to be empty in 2028. Social Security's main retirement fund, 2032. That is well inside a normal 10-year planning window. Incredibly painful political choices are coming, and they are coming fast.
So this all boils down to the one question that really matters. At what point does this accounting problem become a market event? When do the bond markets wake up, look at this balance sheet, and start demanding a risk premium for lending to the U.S. government?
So, with all that in mind, how does this change the outlook for the next quarter? The report's updated Monte Carlo analysis gives us a very clear and very sober picture of how the odds have shifted in just the last few days. The big story here is the complete collapse of the optimistic scenario. The chance of a rapid de-escalation has been slashed to just 12%. The most likely outcome, our new base case at 43%, is a prolonged conflict with stubbornly high oil prices. But here's the really worrying part. The risk of a full Strait closure, a true oil spike event, has now risen to a 24% probability. When you look at it this way, it's just crystal clear.
Add up the base case and the escalation scenario, you get 67%. That means 2/3 of all probable outcomes now involve a sustained or worsening conflict. That has to be our new operating assumption.
So, we get to the bottom line. What do you do now? The report is incredibly direct on this point. It lays out a non-negotiable action for all financial and strategy teams.
Here it is. This is the new mandate. It's called the U.S. Fiscal Risk Overlay. And what it means, in plain English, is that the age-old assumption that U.S. Treasuries are the risk-free rate is over. It's done. From this point forward, that assumption must be actively challenged and stress-tested in all of your valuation models.
And this isn't just some vague concept. They give us a precise playbook. Your teams need to be implementing these 3 specific steps, starting today, to bake this new layer of sovereign risk into any valuation of a U.S.-based asset. No exceptions.
And this brings us full circle, doesn't it? This perfectly illustrates the new landscape we have to navigate. You have a historically indebted public sphere right next to a massively capitalized, independent, private innovation engine. The capital, the growth, and frankly the risk, they're just not in the same places they were 5 years ago.
Which brings us to the final, provocative question the report leaves us with. It's a question that upends decades of financial theory, and it's the question that should now be at the absolute center of your long-term capital allocation strategy.